recording. All right. So this was just kind of a, what we just did was just an equity valuation summary. Let's go ahead and go back. And let's go back, and I'm going to share the screen again. But this time what I've got up is those first questions that we did. Now we've already done these, okay? But now that you've kind of seen, hey, we're trying to find an intrinsic value, for company ZZ that's expected to pay $1.75 in dividends. I don't know what just happened. My drawing tool got crazy. All right, $1.75 in dividends 1 year from now, and is also expected to sell for $60 1 year from now. Okay. So if you have a required rate of return of 13.4%, the question is, how much should you pay today so that you can earn 13.4% if you're expecting to get back $61.75? So in this case, the intrinsic value is just the present value of the dividend and the horizon value. Okay. So finding that is pretty easy. You can use your calculator. You can use net present value. I showed some of you how to use that. You can do it by hand. Okay. P0 is equal to, or we can even use PV. Let's go back to what we learned in chapter 4, the very first day. Present value is equal to future value divided by 1 plus I to the T. Okay. So if we wanted to find the present value, and we had $1.75 plus $60, and that was all 1 year from now, we divide it by 1.134 to the first, and 61.75 divided by 1.134 is 54.45. So now the question is, if our intrinsic value is 54.45, does that mean that the investment is a good one if the current market price or selling price is $49.50? And of course, the answer is what? Yes. Okay. Why? Because this security is undervalued. It's under our valuation. And you can also go back and double check to see that if you were to buy it at $49.50, if you were to buy it at $49.50, then you got back $1.75 in dividends plus $60, and you solve for the interest rate that makes $49.50 today worth $61.75 in the future. Apparently that interest rate is 24.7%. And you can solve for that just using your financial calculator. All right, so now we can see as we go into a 2-year methodology, okay, that we had $1.25 and $1.50 and then $72 at the end of 2 years. Okay. So now the question was, how do you find the present value? The present value is just the sum of the present value of these two cash flows. And you can do it a lot of different ways. Discounted, of course, at the required rate of return. All right. So this is the present value of the cash flow in year one. The year two cash flow is $72 plus $1.50 divided by 1.113 squared. And you can do this, and then add up these, and you should get 6046. All right. So what you find out then is if the intrinsic value at 6046 is sort of the most you'll pay for something, then what happens if it's selling at 63.48 today? Then this stock would be over our valuation or overvalued. All right, last thing I'll do is show you the constant growth rate, and then we'll work some of the problems. So let's suppose we have a stock that's expected to pay $1 dividend at the end of year one, $1.20 at the end of year two, and after year two, it's expected to grow at a constant rate of 8%. So year 3, 4, 5, all the way out to infinity, the dividend just keeps growing and growing. And remember, though, this is just a model. Okay, it's not going to actually grow this rate. After all, you can see that a lot of times things are going along and it looks like the economy's going pretty well, and then all of a sudden, what? Something unexpected can happen. That's why you're not discounting these at the risk-free rate. What's the unexpected thing that can happen? I don't know. I mean, a virus comes and puts everyone at home, okay? And the economy's shut down and people aren't buying things. And so, no one would have foresaw that coming, okay? So those are part of the things that are unexpected, okay? So in order to account for that risk, that's why we're not counting these the same as treasury bills, okay? So what we can see is if we have a constant growing perpetuity, this is the portion that is constantly growing. Okay. So you have to go at where this begins. This is really the beginning of year three. But the beginning of year three is the same as the end of year two. So a lot of times we just write it as P2 to account for the beginning of year three, which remember was New Year's Eve. Okay. And all of a sudden, the ball drops and you went from one year to the next, but no time has really passed. That's what we're talking about here. Okay. So when we say P2, we really mean the beginning of year three. But since we're doing all of ours in the end mode on the calculator, we often write it as P2. So P2 is going to be equal to D3 divided by R minus G. That's how we find the present value of a perpetuity. So in this case, how do we find D3? D3 is unknown, but we know D2 is equal to $1.20, and D3, if everything's growing at 8%, will be 8% higher. Okay. So in this case, D3 at $1.20 for D2, D3 is going to end up being $1.29.6. The required rate of return was 12.7, and the growth rate was 8. Okay. So in order to find P2, need some more room. All right, so we find P2 at 27.57. But remember, I said, don't get excited that you found the horizon value. Because we're really looking for the intrinsic value. So once you found it, now you can go back and find the present value of the dividends and the selling price. All right, and if we take this is 89 cents. This is 14.78. Oops, that doesn't look right. 27.57 plus $1.20. It's 28.77. This is 22.65 plus the 89 cents. Should give you an intrinsic value of 23.54. Let me clean this up a little bit. So what we really had was we found that we were getting $1 dividend 1 year from now, $1.20 in dividends 2 years from now, and we found our horizon value to be 27.57. And we need to go back and then find the present value of those two cash flows. And we found that the present value of $1 was 89 cents. And the present value of 27.57 plus $1.20 was 22.65. We added those together, we got 23.54.
Where are you getting the 23 or the second one you got? That was like $22, 22.65.
How did they get the 22.65? All right. So remember, in year 2, we found the 27.57 and the $1.20. This was the dividend. This was the horizon value. Okay. So we had to go back and find the present value of those cash flows. Okay. All right, so if we look right here, how we found that was I just took 27.57 plus $1.20. Those are the two cash flows. And divided it by 1 plus I squared. That's what gave me the 22.65. Okay. The 89 cents was found by taking the present value of $1. Then I added those two things together. Does that make sense? Okay.
Why is there no horizon value for year 1?
because we don't have constant growth.
Okay.
So the only time, so that's kind of an important point that maybe I went over. Didn't, okay. So if you look at, I'm just gonna go down here to the bottom. If you look at a perpetuity, okay, so remember when we set up that endowment fund, okay, and we said, hey, okay, I want to give away $5,000. I don't know what we're giving away. I want to give away $5,000 a year as a scholarship. How can I do that if the appropriate interest rate is, say, 6%? Okay. Well, we could have done mathematics, but I chose not to do the mathematical formula. And I just said, hey, let's use intuition. What if I tell you that the present value of a perpetuity is just equal to the first cash flow divided by the interest rate? And I said, hey, if we took 5,000 and divided it by 0.06, what do we end up with? We end up with $83,333. And I said, does that kind of make sense? And we said, well, let's look at it. If I put in $83,333 into a bank account in year 0, and it earned 6% interest, how much interest would it earn? Well, if we put in 83,333 and it earned 6% interest, that would generate $5,000. And I said, hey, if we want to spend $5,000 every year, is there a way to do it and we never run out of money? And we kind of use the argument that, hey, if we only spend the interest and never spend the principal, how can we run out of money? So if we put in 83,000, it earns 6%, we get $5,000, we spend 5,000, we leave the principal in and only spend the interest, it will last forever. Now, the next question was, what if we want that 5,000 to be the first cash flow, but everything else grow at some rate? And let's say maybe we want it to grow at 2%. Now what happens to the formula? The present value of the perpetuity that's growing is equal to the first cash flow divided by the interest rate minus G. So now all of a sudden, if we want to have $5,000, but we want that to grow by 2% because we figure tuition's going to go up. Now, if we divide it by I minus G, now instead of 83,000, we've got to put up 125. That way we can generate more than 5,000 in interest, and that difference will be used to pay or offset the increase over time that we're wanting to have happen. Now you can go to YouTube or whatever, and you can watch something. This derivation is like a page-long derivation to figure it out, okay? But if you want to see it, you can. If not, you kind of have to go on intuition. But there's 2 rules. This equation only works under the following conditions. The interest rate has to be greater than G, and G has to be constant. And so if you don't have constant growth, you can't use a present value of a growing perpetuity because you don't have constant growth. All right, let me stop sharing the screen and let's see if we have any other questions. All right, we have any other questions from? Those are all those problems we went over before we left for spring break. So it's just kind of hopefully somewhat of a review. Okay. Now, here's the ones that I wanted you to do before we came back. this chapter 7 questions. And I think it's something like, starts out with healthy foods. Okay. And these are ones that, you know, we can do in class, or I guess we'll do in classes to see. But let me go ahead and share the screen and see if you can find them. They're on the Moodle page. I just can't remember what they're called. All right, they look something like this. I think they're either called Prepare for Class or something along those lines. All right, so if it just paid its annual dividend of $1.45, and it's announcing that it will increase all future dividends by 2.8% annually. This is the constant growth part. Okay. What is one share of stock worth to you? That's called the intrinsic value if you require a 14% return. All right, I'm going to go ahead and probably give myself more room. All right, so if we look at it, let's draw it out. The last dividend that was paid was $1.45. Ooh. All right, was $1.45. Now, that came from earnings per share that were earned in the previous quarter. Okay. That's the information that we'll use to figure out if we buy it today, we don't get the dividend that they just paid. Okay. We don't get this. We get any dividends in the future. And what we're hoping is that the future dividends will increase by 2.8%. So if that's our estimate, then $1.45 was last year's dividend. I'll just do the dividends for the next 3 years. Then we're expecting the dividend a year from now to go up by 2.08%. So if it's going to grow by 2.8%, then the dividend next year should be $1.49. And if you want to be real specific, $1.4906. Okay. Now, if that dividend keeps increasing at a constant rate, it means all future dividends will also grow at 2.8%, which would be $1.53. And then D3 would be $1.575. And we could keep doing this on and on and on forever. Okay. But since we have some conditions that are met, that is, growth is constant at 2.8%, we really want to start at the beginning of this annuity, which is the beginning of year one, okay, which is kind of like the beginning of year one is just today. So that P0 equals D1 divided by R minus G. And we can find the present value of this growing perpetuity by taking $1.49 and dividing it by 0.112. And I got 1330. The reason I didn't get 1331 is because I didn't put in the 06 here. Yeah. If you want to be real specific, you can put in the 06. And you get 1331. So this is just a straightforward perpetuity. R, the required rate of return, is greater than G. We found D1. And you can see that you can find the price at any point in time, as long as growth is constant. So Klaus Toys just paid an annual dividend of $1.40. Remember, that dividend they just paid, you don't get. So it doesn't show up anywhere in the problem. It's just used to help you figure out what future dividends will be. So now they're figuring, hey, dividends in the future are going to grow at 2%. Relative to where they are today. Okay. And we want to find the price of the stock 5 years from now. So if this is true, then the stock price 5 years from now is just the present value of all the dividends after year 5. So we're really starting at the beginning of year 6 and finding the present value of all the dividends from years 6, 7, 8, 9 to infinity. So in order to solve this equation, then we've got to figure out what D6 is. We know D0, and that's good. We know that there's constant growth, so that'll be helpful. So if D0 is $1.40, then D1 is $1.40 times 1.028, growing at 2.8%. And if you wanted to find out what it was, it'd be $1.4392. And if you wanted to find D2, it's $1.4392, growing at 2.8%.
Oh, I thought the growth was only 2%.
Correct. Good point. All right. $1.40 times 1.02 is $1.428. I like the eraser. Now we're at $1.4566. And let's just keep it consistent. And finally, we can find D6. All right. So after all that work, If we take all that, divide it by the interest rate minus G, which would be dividing it by 0.14, end up with 1126. All right. There we go. All right, any questions on the constant growth?
Why would we go off of D6 instead of D5?
Because we're trying to find the price 5 years from now. So 1 year from now would be the end of year 1. 2 years from now would be the end of year 2. 3 years from now, the end of year 3. So we're trying to find at the end of year 5. The end of year 5, okay, is the same as the beginning of year 6. So we're trying to find the present value at the end of year 5, which is really the beginning of year 6. So that's kind of how we solve that one. All right, any other questions? Oh, someone said, can't you do it 1.4 times 1.02 raised to the 6th power? Yes, you can. D1 is raised to the 1st, D2 is raised to the 2nd, D3 would be taking, so you could write it, you can look at it right here. So D2, instead of be written as D1 times 1 plus G, D2 could be written as D0 times 1 plus G squared. So you can get to it by taking D6 would just be written as D0 times 1 plus 0.02 to the 6th. Yes, that works every time. Oh, I wasn't showing you my screen share. Sorry. So yeah, so here's the screen share. So D2 is equal to D1 times 1 plus G. So D2 could also be D0 times 1 plus G squared. So D6 could also be D0 times 1 plus G to the 6th. All right. Let's skip the next one. We'll come back to it if we have time. All right. Let's go down here and look at this Tasty Treats. Common stock of Tasty Treats is valued at $10.80 a share. The company increases its dividend at 8% annually. So growth is constant at 8%. The next dividend is expected to be 20%, or 20 cents, excuse me, 20 cents per share. All right, so what we have is we have D1 is 20 cents. We have growth at 8%. And we've got an intrinsic valuation of around 1080. And the question is, what do people expect the rate of return of this stock to be given these fundamentals? If these fundamentals are true, then what's the expected rate of return on this stock? So we're now solving for R. So if we go back and say, hey, if P0 is equal to D1 divided by R minus G, but if we knew P0 and we were given D1 and we were given R, now solving for R, we were given G at 8%, then how can we solve for R? Okay, well, luckily for us, this is one equation with one unknown, and we can solve for it. We just have to do some rearranging. Okay, so what we can do, P0 times R minus G is equal to D1. So then R minus G is equal to D1 over P0. So then R is equal to D1 over P0 plus G. And so if we have all these, now they were given, okay, that you expect 20 cents in dividends next year. The valuation you came up with was 1080, and the growth rate is 8%. Then R is just D1 over P0 plus G, and we can solve for the required rate of return given these assumptions provided above. Given that we've got a 1080 valuation, given that we've got a 20-cent dividend, and given that we've got an 8% required rate of return. Now, what's kind of neat about this is that this, here's your total return. Your total return is a function of, this is what's known as the dividend yield or expected dividend yield. And this, under a constant growing perpetuity, this is what you expect the capital gain or price appreciation of the stock to do. So when you're assuming constant growth at 8%, you're basically assuming that the price of the stock will increase by 8% a year, and that the dividend at 20 cents next year will provide you with a $1.85 yield. The dividend will go up, the price will go up, so your dividend yield will remain the same. That's kind of a slick little piece of information. So you can see in this next problem, it's helpful. If River Rock just paid an annual dividend of $2.80, then the dividend next year is expected to grow by 2.5%. The dividend next year is $2.87, okay? And it expects to keep doing so in the future. What will this stock be worth 6 years from now? Okay. So in order to find P6, we're going to need D7. They gave us the required rate of return. They gave us the growth rate. All right. So you could go through and find all these, or as someone suggested, hey, why don't we just take D7 as a function of D0 and raise it to the 7th power. Okay. So D7 is equal to $2.80, growing at 2.5%, but it's doing so for 7 years. So that would put D7 at $3 and almost 33 cents. So P6 is equal to D7 divided by R minus G. If I take that you get 24.65. Okay. So that was kind of the traditional way to do it. But if you also recognize that the constant growth rate is 2.5%, and you realize that the constant growth rate is also the price appreciation of the stock, you could have found P1 or P0 and then just increased it by 2.5%. But anyway, that's just sort of a fun little fact, I guess. All right, let's do this. Let me see if there's any questions first. All right, let's see. Any other questions? All right, let's go ahead and look at this last one. Auto transmission is expected to report earnings per share. And remember, this is earnings per share. Earnings per share in year 1 of $4, and earnings per share in year 2 of $4.50. Now remember, out of that earnings per share comes from net income. So earnings per share is net income divided by number of shares outstanding. And the net income either gets paid out as a dividend or reinvested back into the firm under retained earnings. And that's how the company grows. That's how we get the constant growth rate. Okay. So in this case, if they're going to pay out 40% of the earnings as dividends, then that means we expect the dividend in year 1 to be $1.60, and the dividend in year 2 to be $1.80. We also expect the company to trade at a P multiple of 19. Okay. So now, if we want to find the horizon value, we know that P2 over earnings per share 2 is expected to be 19. If earnings per share 2 is 450, then P2 would be equal to 85.50. Now to find the intrinsic value, I've got to find the present value of $1.60 at 12%. And the present value of $1.80 plus 85.50. Those are both in year 2. This is worth $1.43 roughly. This is worth $87.30. No, sorry. No, it's not. $69.60. And if we add those together, we get 7102, 7103. Doesn't matter. All right, so any questions we have on that one sheet that was kind of like, I think it's called prepare for class questions. I'm not sure what it was called.
In the last problem, where you get the dividend price, like the $1.60 and then the $1.80, how'd you find that?
Okay. All right. So remember they reported, or we were expecting earnings per share of $4 in year 1 and $4.50 in year 2. All right. Now, I'm just going to write up above here real quick. So think about the $4 in earnings per share. Remember that the earnings per share is just net income divided by number of shares outstanding. And if you remember on our income statement, we had revenues minus costs, blah, 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 and we got net income. Where were the 2 places that net income could go? What do companies do with the net income?
The dividend payout?
They either pay out some of it as cash, or they take some of that net income and pay it out as cash, which is why we usually report net income divided by number of shares outstanding, and we call that dividends per share. Okay? So they pay out a portion of net income as cash, and then what do they do with the rest of it? They retain it for growth. So what they don't pay out, they retain so that they can get bigger next year. So out of the $4, how much are they going to pay out as a dividend? They're paying out 40% of the earnings as dividends. So on a per share basis, $4 times 0.4. Oh, anyway, hold on. Dang it. I drew all that for nothing. So what's happening is the $4 of earnings per share, they're paying out 40% as a dividend. And that's how we get the $1.60 in year one. In year two, they're paying out what? $4.50 as a dividend. I mean, as earnings is what we're expecting. They're paying out 40% of that. So D2 is $4.50 times 0.4, which is $1.80. So the short answer is that the dividends come from the earnings that are paid out. And obviously, if they pay out 40%, then they're going to retain 60. So you might see a question somewhere along the line that gives you the retention ratio instead of the dividend payout ratio. All right. Any other questions? Let me stop the screen sharing. Let's see. All right. Does that kind of make sense? All right, let's see what else we have. Not that.
Yeah, skipped over 3, didn't we?
Oh, you want to go back to that?
A little extra practice.
Sure. Oops, I might have lost it. I'll find it here. All right, so yeah, it was called Chapter 7, Prepare for Class, is what those were. All right, let's go back to screen share. All right. So you wanted to see Atlas Home Supply? Yes?
Yeah.
Yeah, okay. All right, Atlas Home Supply paid a constant dividend of $2.40 a share for the past 15 years. So that's what the dividend's been for the last few years. Wants to increase its dividend by 10% and stay there through year 3. So we've got to figure out what the dividend in year 1, and it will be the same in year 2 and the same in year 3. What we know was the dividend in the past was $2.40, and the dividend in the future is going to be 10% higher. So it's going to be $2.64. And then that dividend's going to do what? Stay there. For the next 3 years. After which time the dividends will increase by 2% annually. So now we have constant growth, but here this was level growth, but it wasn't perpetual. It was just for the next couple of years. Now we have growth that's constant at 2%, and we really need to find the horizon value at the beginning of when this is occurring, the beginning of year 4, which is the same as the end of year 3. So in order to find the dividend in year 4, we need to know the dividend in year 3, and we're going to grow it at 2%. Well, the dividend in year 3 was $2.64. So the dividend in year 4 is going to be $2.69.3. And then it goes up and up and up at 2%. If the required rate of return is 12%, that's our R. We know growth was 2%. So P3 is going to be equal to 26.93. Okay. Now don't get excited. That's not the end. Okay. You just found the horizon value. Now we have to go back and find the intrinsic value, because you found the selling price at year 3, but we still have to find the valuation today. Okay. So now we've got to go back and find the present value of the $2.64 in year 1, $2.64 in year 2, the $2.64 in year 3, plus the $26.93, all discounted at 12% interest. And if you do that, you should get the $25.51. All right, well, it looks like we're at the end of our first Zoom class. Not terrible. Not perfect, not terrible. Okay. Hopefully we'll have more people interrupting. It's hard for me. I can do it, talk for an hour and 15 minutes, but I'd prefer not to. So anyway, I'll go ahead and stop this and record it. We've got one more day of chapter 7. That'll be kind of review, but go ahead and look. I'm going to send you an email. I'll probably give you a quiz sometime today, and it'll be obviously take home, and you got to figure out how to get it back to me the best way you can. And maybe it is just uploading and downloading it, or maybe it's printing it off and writing on it and taking a picture. But figure out a good way. And if you have questions, email me, or I gave you my Google Voice number too. So that'll work. All right. So look for an email from me, and I'll figure out how to post it online. I don't know if it'll be in Drop. It'll be somehow. I can't remember how it works. I've done it before. I just don't know how to do it yet. If not, you just download. But it'll eventually be one where you you click on something and it'll come to you, and then you have to upload it back to me somehow. So, all right. See you guys Thursday. And we'll just kind of review, look over all that stuff from the chapters for the test. And Thursday will probably be mostly review, but we can also answer some questions. All right. See you Thursday.